Marti Technologies, ticker MRT, just dropped their Q2 2026 earnings. They beat revenue consensus but missed on EPS. Revenue surged like 141% year over year to $20 million, which blew past the 16.69 million estimate. But EPS came in at a loss of 15 cents, and that missed the consensus of a 6-cent loss.
Yeah, but management really didn't flinch at that bottom line miss. I mean, they actually raised their full year 2026 guidance to $85 million in revenue and $7 million in adjusted EBITDA. And the market totally rewarded them. The stock jumped roughly 3.5%, trading around $2.12 right after the report.
So looking at these earnings notes and the management commentary, the mission for today's deep dive is answering one question for you. Why exactly is the market sharing a pretty substantial bottom line miss?
Well, you have to look under the hood at the operational inflection point here. Gross margins just hit a record 77%. And for the first time in company history, adjusted EBITDA turned positive, coming in at $2.9 million.
Wow. Okay. And looking at the segment breakdown, they had this massive 73% jump in total trips, right?
Yeah, hitting $18.8 million for the quarter.
Exactly. But at the exact same time, they reduced their deployed two-wheeled EVs by 13%. So they are intentionally retiring older fleet vehicles. It kind of reminds me of a company moving away from owning their own massive, expensive server racks, trimming the fat to sprint faster.
Oh yeah, switching to the cloud, basically. Shedding physical assets to focus on higher margin subscriptions.
Right, but I have to push back here. If their new strategy relies so heavily on platform monetization and third-party ride-hailing rather than expanding their own hardware footprint, doesn't that inherently cap their overall growth?
You would think so, but it actually removes the cap. By shifting focus toward ride-hailing and subscription monetization, Marti is unlocking some serious operating leverage.
Because they don't have to keep buying all those scooters.
Exactly. They no longer have to constantly buy, deploy, maintain, and charge thousands of physical scooters just to grow their revenue. By monetizing the software and the network effect instead, well, they scale much faster without the massive capital expenditure. That is exactly how they pushed those gross margins up to 77%.
Okay, so if they are moving away from managing their own two-wheeled hardware, how do they plan to actually capture future market share? Because that brings us to the new announcement, right?
The Tensor partnership.
Yeah, a multi-year partnership with Tensor to deploy Level 4 autonomous vehicles across Turkey.
Right, and Level 4 autonomy is really the key factor here. It means the vehicle operates entirely without human intervention within specific geographic boundaries. For Marti's unit economics, removing the human driver completely transforms their margin structure.
Because there's no manual logistics for repositioning vehicles either.
Exactly. You are taking their existing ride-hailing user base and routing it into a highly automated, low-variable cost system. It's incredibly efficient.
I mean, that sounds great on paper, but let's get back to the actual earnings miss for a second. Because this report definitely has some dents in it.
Oh, it definitely does.
Yeah.
Let's break down that EPS miss. A really large chunk of it was driven by an $8.3 million non-cash loss on debt extinguishment.
Which, for anyone tracking the balance sheet, retiring debt early often means paying a premium up front, right? To close out those expensive loans.
Yep, you take the hit now. It creates a painful loss on today's income statement, but it usually saves cash flow long-term by cutting out those high interest payments.
And they desperately need those savings, considering they are still carrying $102.4 million in long-term debt. Not to mention, they operate a highly seasonal business. When winter hits Turkey, those trip volumes will inevitably drop, compressing those record margins.
For sure. Plus, there's a significant regulatory shadow hanging over them. A pending Turkish court decision recently labeled their core ride-hailing service as unfair competition.
And to be clear, we are purely looking at the financial implications here. We are not taking sides on local transit regulations at all.
No, of course not. But objectively speaking, if an adverse legal ruling forces them to alter or just halt operations, well, it directly threatens their highest growth segment.
So you have a company juggling massive debt, unpredictable seasonal weather, and entrenched regulatory battles, all while trying to execute this major pivot to autonomous software.
It requires a pretty flawless tightrope walk. I mean, they have the operating leverage now, but the margin for error is essentially zero.
Right. Well, if you are tracking these earnings for your portfolio and want to stay ahead of the markets, make sure you follow this deep dive for your daily earnings coverage.
Good call. You definitely want to keep an eye on how they navigate all this.
Definitely. Because as Marty races to integrate level 4 autonomous vehicles while fighting regulatory battles and carrying heavy debt, it leaves you with something to really consider. Are they building an asset-light, futuristic mobility monopoly, or simply accelerating their way toward a liquidity cliff?